Welcome back to the Mortgage Reports. Today we're tackling a big topic that affects everyone, the Federal Reserve, or the Fed. You've probably heard the news headlines like, the Fed raised rates again, or the Fed is cutting rates, but what does that actually mean? So how does an organization in Washington, D.C. end up changing what you pay for your mortgage or your car loan? So don't worry, by the end of this video, you'll understand who the Fed is, what they do, and how their decisions shape everyday finances. So what exactly is the Federal Reserve? The Federal Reserve, often called the Fed, is the central bank of the United States. That means it's the main organization responsible for keeping our financial system stable and our economy running smoothly. Now, the Fed was created back in 1913 after a series of financial crises showed that the country needed a system to manage money, credit, and banking more effectively. Think of it as the referee of the financial system. Now, it doesn't own the banks, but it sets the rules and makes sure everything runs fairly and predictably. The Fed's main jobs include managing inflation, supporting employment, supervising banks, and making sure the US dollar stays reliable both here and around the world. So who runs the Fed and how are decisions made? The Fed isn't run by just one person. It's made up of several parts. And at the top is the Board of Governors, based in Washington, D.C., which oversees the system. Then there are 12 regional Federal Reserve banks spread across the country, each serving a specific area. The group that actually decides whether to raise or lower interest rates is called the Federal Open Market Committee, or FOMC. This committee meets about 8 times a year to review how the economy is doing, looking at things like inflation, job growth, and consumer spending, and then votes on whether to change something called the federal funds rate. So what is the federal funds rate? The federal funds rate is the interest rate that the banks charge each other for very short-term loans, usually overnight. You might be thinking, why would banks lend to each other overnight? Well, banks are required to keep a certain amount of cash, called reserves, in case customers need to withdraw money or make large transactions. Sometimes a bank ends up with more than it needs, and another bank ends up short. So they lend and borrow from each other to balance things out. The Fed sets a target range for this rate, and for example, it's maybe between 4 and 4.25%, and uses tools to encourage banks to stay within that range. Even though it sounds like something that only affects banks, it actually has a domino effect throughout the entire economy. So how do changes in the Fed's rate affect everyday people? When the Fed changes the federal funds rate, it indirectly changes how expensive it is for everyone to borrow money. So here's how it works. When the Fed raises rates, borrowing becomes more expensive for banks. In response, banks raise the interest rates they charge consumers for things like credit cards and car loans. This usually slows down spending and helps control inflation, but it can also make it harder for people to afford large purchases. When the Fed lowers rates, borrowing becomes cheaper, which encourages people and businesses to spend and invest more. That can help boost the economy, especially during slowdowns or recessions. But if rates stay too low for too long, it can also cause prices to rise too quickly, and that's inflation. So in short, every time the Fed makes a move, it sets off a chain reaction that affects your wallet, whether you're saving, borrowing, or investing. Now, how does this connect to mortgage rates? Here's where it hits home literally. The Fed doesn't directly set mortgage rates, but its actions heavily influence them. Mortgage rates are more closely tied to long-term factors like the bond market and inflation expectations. But since investors pay close attention to what the Fed does, changes to the federal funds rate can quickly ripple into the mortgage markets. When the Fed raises rates, investors often expect higher borrowing costs in the future, which pushes up yields on things like the 10-year Treasury bond. And mortgage rates usually rise along with it. When the Fed lowers rates, it can have the opposite effect, helping to bring mortgage rates down. It's also worth noting that during tough economic times, the Fed can take extra steps to support the housing market, like buying mortgage-backed securities to push down long-term rates. That's something we saw during the financial crisis in 2008 and again during the COVID-19 pandemic. So what's happening with the Fed right now? Well, as of 2025, the Fed has recently started cutting interest rates after a few years of keeping them high to fight inflation. Inflation has cooled off, but not completely, so the Fed is moving carefully, lowering rates in small steps while watching to make sure prices don't start climbing too fast again. These rate cuts are meant to make borrowing a little cheaper for consumers and businesses, which can help support the economy if growth starts to slow. That means mortgage rates might start easing down, but probably not dramatically overnight. So what does this mean if I'm thinking about buying or refinancing a home? If you're in the market for a mortgage, the Fed's moves are definitely worth watching. When the Fed is cutting rates, mortgage rates can gradually trend lower, which might be a good time to refinance or lock in a new home loan. But remember, mortgage rates depend on more than just the Fed. They're influenced by inflation, investor demand, and your own financial profile, things like your credit score, down payment, and debt-to-income ratio. If the Fed signals that it might raise rates again to keep inflation in check, that could push mortgage rates back up. So timing, along with your personal financial situation, plays a big role. Why does the Fed matter so much to regular people? Well, even though the Fed might seem distant and technical, its decisions shape everyday financial life. They determine how affordable it is to buy a home, how much interest you earn on savings, and even how many jobs are available in the economy. When the Fed strikes the right balance, keeping inflation low and the job market strong, it helps maintain steady economic growth. But when rates move too far in one direction, everyone feels it, whether it's higher loan payments or slower hiring. So understanding what the Fed does helps you make smarter money decisions, especially with big commitments like a mortgage. And that's your quick guide to the Federal Reserve, what it is, what it does, and how it affects your mortgage and your money. So if you found this helpful, hit the like, subscribe, and drop a comment below with your biggest questions on mortgages. Don't forget to check out our website for more mortgage education. Thanks for watching, and I'll see you in the next video.